comment to bring that to the attention of our speakers. And what we will do is we will be using hopefully a selection of those questions that have been raised during the webinar throughout the webinar sessions of the three speakers. We will try and choose some of those questions to come up as questions for the moderated panel discussion. You'll understand with well in excess of 100 webinar participants, we're unfortunately not able to open up to verbal audio questions from the floor, but we do hope that the Q&A function via the Q&A tab will support active engagement during the webinar. We will be making the speaker presentations available to you post the webinar, and of course, if you want to get in touch with any of our expert speakers, you're very welcome to do that, and I'm sure many of them will provide their contact details in their presentation slide decks. We've got 2 hours. We're going to do our best to keep to that. We have planned a 10-minute comfort break, which will be between our second and third speakers. That's an opportunity just to grab a quick cup of coffee, to freshen up, and that would then take us back into our third speaker and the moderated panel discussion. So what I'd like to do now is to just ask Adolphe to help us and just to load the first polling question. This is really just to test whether the polling functionality is working. So you should see a pop-up on your screen with a question. Unfortunately, because I have to share my whole screen, I haven't seen the pop-up question. I'm wondering if somebody could just okay, we need 5 minutes for that. So what we're going to do then is we're going to move on. I'm going to ask Erosha, who's going to introduce our 3 speakers, after which we will then proceed with our first speaker. So Erosha, if I can ask you to just speak to our webinar agenda and also to introduce our 3 speakers. Thank you very much.
Thank you, Adrian. I trust everybody can hear me. A very warm welcome to all of you today. Thank you very much for joining this complimentary ESG webinar, which is being hosted by Six Capitals and Alternative Prosperity. We aim to bring you today expert presenters who will share their views on the rise of ESG, stakeholder capitalism, and the search for inclusive economic growth in a post-COVID-19 new reality, and what this means for business and society. As per our agenda, we have 3 speakers that have prepared presentations for you today. And as we will also have a moderated panel discussion. Allow me, please, for those of you who are not familiar with Alternative Prosperity or Six Capitals, to do a very brief introduction. At Alternative Prosperity, our objective is simple. We are in the business to enable organizations to make decisions that will build trust and create wealth and positive impact for its stakeholders. And we do this through the services and products offered by the different business units within the holding company. At Alternative Prosperity Advisory and Products, we work with South African businesses or businesses operating in a South African environment to address broad-based Black economic empowerment and transformation in a manner that creates shared value. At Six Capitals, we work with asset owners and asset managers, offering responsible and impact investment advisory and ESG advisory services. I also have the pleasure today of introducing our guest speakers. And I would like to start with our third speaker, as per our agenda today, who is Gray Maguire. Gray is currently the Green Economy Coordinator at the Western Cape Provincial Government. Gray holds an MSc degree from WITS in Global Change Studies and has been working in the green economy space for over a decade. His current roles include Green Economy Coordination at the Department of Environmental Affairs and Development Planning at the Western Cape Government. Our second speaker for today is Robert Lewinson, who is Head of ESG Engagement at Old Mutual. Robert joined the Old Mutual Investment Group Responsible Investment Team in October 2014. He is responsible for proxy voting and engagement, representing Old Mutual Investment Group on various industry bodies and championing responsible investment for the Old Mutual Group. Robert's legal and corporate governance background enables him to bring his knowledge of law and negotiation skills to the fore in promoting clients' interests. And our first speaker for this morning is Shamila Subramani, who is the Chief Sustainability Officer at the JSE. And she is also the current chair of the World Federation of Exchanges Sustainability Working Group and member of the strategy group of the Global Investors for Sustainable Development Alliance. She represents the JSE and various industry advisory panels locally and globally related to sustainability, responsible investing, and climate change. Shamila completed her master's program in sustainability leadership at the University of Cambridge and holds a Master of Business Administration from the University of Pretoria, Gordon Institute of Business Science. She is also the recipient of the Chevening and Mansion House Scholarships and is a member of the Institute of Directors of Southern Africa. So without further ado, I would like to hand you over now to our first speaker, Shamila.
Hi, good morning, everybody, and a warm welcome to you from quite a chilly Johannesburg this morning. It's great to be with all of you, and of course, okay, great. Could I just have a confirmation from the team setting up that my screen is visible to everybody?
It is. It's visible, Shamila. We just lost a little bit of your introduction there on the sound side until your screen came up. You can just go put it on full screen, but then if you don't mind, just start again, please.
Fantastic. Okay, I'm glad that you can see that. So yes, my introduction was a very warm welcome to everybody from a rather chilly Johannesburg. And but I hope that what we have to share with you today will be warming and hopefully something very valuable to you. It's an absolute pleasure to be here. Thank you very much to Six Capitals and Alternative Prosperity for inviting me on behalf of the JSE. It's an absolute honor to share this sort of content. So some of you may be wondering what on earth a stock exchange is doing in this discussion. And I'd like to quickly take you through a few facts and figures and what we are as the stock exchange. So the Johannesburg Stock Exchange itself is amongst some of the top 20 exchanges globally on a market capitalization basis. We're fully vertically and horizontally integrated, which means that we effectively service everything from listing, trading, clearing, settlement, and the provision of data. And we also list a number of products across the spectrum and across the asset classes. It's important to note this because it does talk to then how we consider sustainability at the core of our strategy and what our offerings are. We're also a self-regulatory organization, which effectively means that we have certain divisions within the JSE that perform regulatory functions and are allowed to do so because of the Financial Markets Act, which allows for a self-regulatory organization. And that would be the issuer regulation team as well as the market surveillance team. For those of you not familiar, the issuer regulation team would be the sort of team that polices things like listings. So if you're a listed company, it would make sure ensure that you're always reporting in the public domain the information that you need to, and would provide the rules and the policing around that. Market surveillance in its simplest form is really what all the movies are made about, and this is like your insider trading and the policing of effectively just making sure that trading happens in a safe environment, in a fair environment, and that there isn't information asymmetry. So that is the market surveillance and the areas that we look at. The exchange itself has been considered very early leader in sustainability, with our activities dating as far back as 2002. So before I get into the details of what we look at in relation to sustainability and how we consider this, I want to quickly show you this flow of funds framework. It's a little bit unclear, it might be a little bit unclear, but effectively this shows you where an exchange fits in the broader financial services and flow of funds sort of world. So if you look at the capital markets, companies, institutional investors, exchanges touch a number of these areas. In our simplest form, we're a conduit for money flowing from people who have money to invest to those who need the money to deploy to be able to grow their businesses and therefore support an economy, create jobs and the like. And we're a conduit for that. So around the world, stock exchanges are conduits for trillions of dollars. And as the saying goes, money makes the world go round. So what we do is really try to see how we need to consider sustainability in this context, because we, I think, have the shared understanding amongst us that the way in which development models have taken shape up to now has not been optimal, has excluded largely considerations of the environment and society, and in some instances, even governance has been questionable. So exchanges who sit as conduits of this money do have a role to play and can actually consider their role and how they can influence better sustainability practices. And this is really where we have then conceived of what we can do as the exchange. We wear three faces, and on the top right-hand side of the slide, you look at the triple context for us of a company, an exchange, and a regulator. And so we consider what we do for sustainability in along these different phases. We are a central player in the local economy and we have a global reach. And by that virtue, we need to ensure sustainable access to capital. So the primary function of an exchange, we need to keep going. So keeping the lights on and keeping the business going is very important. The crisis at hand at the moment is testament to that. The exchange was considered one of the essential service providers because let's face it, if you didn't have an exchange, you wouldn't really know how much your pension money really did lose in the last few weeks. Not to make anybody depressed, but that effectively that benchmarking and the functions that we play in ensuring people can trade and we can do that is absolutely critical. But we also are a platform and we can use that voice and our regulatory tools to influence stakeholder behavior. So we are a listed company with our own stakeholders, and there we need to lead by example and integrate ESG and the sustainable development goals into our own operations. And we've considered the fact that sustainability is multifaceted and requires a balancing of many different pressures. In our case, the running of a sustainable business and the external sphere of control and influence that we have over the 380 listed companies that we have and a number of other players that make up the market. So using that context, this is how we've conceived of our approach to sustainability. Adrian asked me to please speak about what we do in relation to ESG and why it matters. And I'm hoping that I'm able to answer that question predominantly with this diagram. So as I've explained, where we are, we're a central player in the economy. And at the center of this diagram, you see that we have conceived that our best role is to create an enabling environment for better sustainability practices to grow. If you consider that there are 380 listed companies that are listed on the JSE, the multiplier effect of any action that we take, as you can concern, is actually quite large and quite significant. And so we've centered our activities on 4 levers that we feel are the best ones that we have to create the sort of influence and enabling environment to the best possible way. So I'm going to start on the top left-hand side with the regulatory framework. As I've mentioned, we're an SRO, so there are certain things that we can do in a regulatory context. And in that regard, we've got certain mandatory requirements, mandatory governance provisions. Some of you would be familiar with the King Codes of Corporate Governance, considered globally as one of the leading codes in corporate governance. And like many of these codes, is really something that is voluntary in nature. However, in the South African context, the JSE has effectively made it mandatory for listed companies to report in accordance with the principles of the King Code. So if you're a listed company, you need to follow the principles of the King Code and do that on what we call an apply and explain basis. King has gone through 4 iterations, and the current regime is the apply and explain basis. The reason this is important is because codified within King is the explicit need to consider environmental, social governance issues and to really consider the strategy of a business and to understand how it impacts on these factors and how these factors impact back on the business itself. So I want to pause for a moment there and understand that the philosophy that we're really looking at that is embedded in King is this issue of needing to embed your sustainability thinking within the governance practices of the business and to have the governing body actually understand that and to take responsibility for that. So this is the explicit consideration and the integration of sustainability considerations into the strategy of the business. So that is the ideal. Is this happening all over the place? Of course it isn't. It is a journey. It is something that King has looked for and that we're seeing over time that companies are getting better and better at. Also, it is important to note by the little thought bubble, is that the JSE is one player in a broader governance system. So we're doing the best we can within our context, and we would obviously do that alongside the other regulators that exist within the broader context. So if we look at, for example, the King codes are the one way. The other way is that we've then taken some of the specific recommendations of the code and codified those into the mandatory disclosure requirements of the JSE. So the ones that are probably the most relevant to sustainability are the fact that we require reporting on gender diversity and racial diversity at a board level, and that this needs to be reported on in a company's annual report, and there needs to be a plan in place around gender and racial diversity. Given the kind of issues we've had in our own society, one can understand why these provisions are important, and that, again, could have a multiplier effect. Part of this is creating a disclosure regime which allows for greater transparency and for other stakeholders in the ecosystem to then use that information to engage with companies and be able to try and promote better behavior and use the different tools which Rob from Omutual will obviously speak to you a little later on. I'm going to keep to the high level of the broader environment. Remuneration policy is the other one. We have a requirement that every company needs to put to vote annually its remuneration policy. It's a non-binding advisory vote, but when you consider that we're one of the most unequal societies in the world, if you look at the Gini coefficient as the barometer, we're the largest Gini coefficient in the world, then actually creating transparency around remuneration policies, I think you would agree, is quite a big step forward in creating once more this transparent environment for better disclosure and therefore better engagement to happen. Moving on to the right, to top right, the ESG investment tools. So the other way that we can help to create this better environment and promote better sustainability practices and investment is by creating the tools that can support this. And we have a few in that regard. The oldest of these, and perhaps the most well-known of these, is the Responsible Investment Index series. Its predecessor, you may know, was the SRI Index, which dates back to 2002, between 2002 and 2004, which was discontinued in 2015 and replaced by the FTSE JSE Responsible Investment Index. So we're in partnership with the FTSE as an index provider and following the FTSE for Good model, which I think is quite well known globally. And that is effectively an ESG rating tool which assesses companies using only publicly available information on very specific criteria in relation to E, S, and G. And so if we look at that, it's a really shorthand for what one considers to be the biggest sustainability challenges globally. I'm just going to skip to the next slide and come back. So if we look at that, a very quick view shows you what this model looks like and what is assessed. So at the heart of it, there is an ESG rating that comes out, but underneath that, to get that final rating, which is out of a 5, which is on a 0 to 5 scale, one needs to consider a number of themes in the environment space, in the social space, and the governance space. And companies are assessed on these various themes using quite a complicated model that is weighted for exposure to certain of these themes. For example, how you would rate a Sasol Limited on climate change would be very different to how you would rate a JSE Limited on climate change. And so there's a level of that tailoring based on sector, based on exposure, and even based on country. And so this is all put together in the model, which comes up with the final ESG rating, which is then given to the companies that qualify to be assessed. So if we go back there, then that rating comes up on a scale of 0 to 5. A company needs to score a 2.9 and above to then be included in the Responsible Investment Index. There are two indices. There's a benchmark index where you get in if you score 2.9 and above, and there's the top 30 version of that, which exactly as it says, we then rank order the benchmark index constituents according to their ESG rating, and the top 30 of those then become constituents of the top 30 index. So it's almost a best-in-class sort of approach. And these are the two indices that we have. The way in which the entry criteria for the indices has been set up has been specifically done to try to make these investable indexes. And so on that, we also have ESG futures on the top 30 index. The other tool that we have in the other asset classes, predominantly in fixed income, is the green bond tool. That is a framework that we went live with at the end of towards the end of 2017, and we have quite a few. The first listing on that segment was, in fact, the City of Cape Town for their green bond, and then followed by Growth Point Properties and 2 tranches by Nedbank, and where the proceeds need to be ring-fenced and earmarked and used for specific types of activities that relate to creating a green economy, lowering emissions, and there's quite a large framework as to what qualifies for green bonds and doesn't. And so we're also expanding that now to become what we're calling the sustainability segment, and that is imminent. It has gone through the public consultation process. So we will add to this use of proceeds model 2 new thematic bonds, being sustainability bonds and social bonds. Very relevant to the current crisis is sustainability social bonds, because many of the bonds that have been issued by a number of players, including sovereigns, in response to the pandemic, have followed largely a social bond framework. So having these instruments at hand answers to many different needs and allows for issuers to be able to separately highlight what they're doing, and allows for investors who have mandates, who are interested in investing in line with their objectives, with their ethics, to be able to find the right sort of products to invest in quite easily. Of course, by being listed, it also makes it easier for institutional investment to be able to invest in these instruments. And so here's where we're creating the tools that will allow, and the products that will allow for money to actually flow to where it's needed to create this sustainable world that we want to create. Project bonds is another one. By creating separate tools, we're helping to support infrastructure development and the like. I'm going to move on then to the next part below that, which is advocacy. So the other role that we see is that we as the JSE obviously sit, at this meeting point of many different parts of the financial services ecosystem. And so what can we do to advocate for sustainable development, to advocate for change, and to be that body that really is taking leadership in this area? There we sit on a number of committees. Hirosh already mentioned the World Federation of Exchanges Sustainability Working Group and the Global Investors for Sustainable Development Alliance. These are activities where we're leading, we're chairing the WFE, we're also co-chairing at a global level the Global Investors for Sustainable Development Alliance. Our CEO co-chairs that. And that the alliance is really looking at trying to increase capital flows to support the sustainable development goals. There is a global understanding that there's a massive deficit in terms of finances that will be required to achieve the sustainable development goals. And so this alliance is bringing together players from around the world to try and consider how we can scale that up from a private sector investment perspective. We're also founding members of the Sustainable Stock Exchanges Initiative, an initiative that started with 5 founding members and now has over 90 exchanges who together are trying to see what they can do, similarly to what the JSE has done to promote sustainable development in their ecosystems. We're a signatory to the Principles for Responsible Investment, and we're also, of course, on the King Committee, So our issue regulation team sits on the King Committee. We're a member of the Codes for Responsible Investment South Africa, and then the Integrated Reporting Committee of South Africa. So you'd remember under the regulatory framework, I talked about King 4, and King 4 also recommends integrated reporting, and that looks at this sort of 6 capitals view, and it talks about how one affects the different capitals. So it's the explicit consideration of capitals other than the purely financial, which we are very accustomed to only looking at. And so this committee obviously looks at trying to promote integrated reporting and how companies can start looking at this integrated thinking process. And then finally, on engagement being the fourth arm that we feel that we could really make an impression in is the issue of engagement. And one of the biggest issues we've come across over a number of years is that many companies say, well, even if we do things in relation to sustainability, when we go on annual results roadshows, nobody asks a single question. So why are we wasting our time with this if nobody cares and all they care about is what has been your return on investment, has your IT spend increased or decreased, and how many people, and what is your people budget? And so these are the kinds of things that we're hearing from companies. And so when this showcase started 10 years ago, it was really with the intent of giving that opportunity for companies who've made significant effort to showcase those activities and bring into the same room investors to specifically listen to these sorts of efforts. The issue there would be that the opportunity there is for this engagement to happen and for that explicitly to be understood. So that is something that has grown in time. The level of engagement has grown over time. And last year, to celebrate the 10th anniversary of the showcase, we focused on the Sustainable Development Goals and partnered with UNPRI as well and the UN Global Compact and the Sustainable Stock Exchanges Initiative to bring this showcase into a sort of almost like a gala event last year. And it was really well received. So we've seen the level of engagement increase, and we've also changed that to now bring in the investor voices more strongly. So this is more of a conversation between the different parts of that ecosystem that enables responsible investment. We also do a number of customized presentation and training to boards of companies, management teams, etc., on understanding sustainability, as well as being able to delve into ESG scores, what those mean, and we also look at partnerships and collaboration. So we've arranged our activities on these 4 areas, and this is where we really see we're able to make the biggest difference in this ecosystem. Have there been any proof points of whether this has really worked or not? So that's a difficult one to answer, but the Sustainable Stock Exchanges Initiative, in partnership with FTSE, at the end of 2018, did a survey of many of the exchanges that are under the Sustainable Stock Exchanges banner and looked at disclosure along 6 of the ESG indicators. So they chose 6, some in environment, some in social, and some in governance, and looked at the levels of disclosure across all of these. Now, here we're talking about developed markets, emerging markets, and the whole lot. They limited it to all companies whose turnover was $1 billion or over. We had quite a few that fell in that category as the JSE. And on every single one of those 6 indicators, our companies ranked in the top 5 for disclosure. This is in the top 5 globally. And on 3 of those 6, we ranked number 1. And this is where this is not mandatory disclosure. This is in this enabling environment where better practices have grown. So I think that making that effort, putting that in place, creating the tools and the instruments it makes a difference. And then also means that globally our market is looked at more favorably and our companies are actually be seen to be making a difference. So that's really where we've arranged our efforts. I've explained to you the ratings model already, so I'm just going to skip to looking very quickly at some of the SDG priorities that we as an exchange have said we probably have the biggest influence over and have identified when we consider our strategy. Would be on reducing inequalities, responsible production and consumption. You can see how things like our indices would actually contribute to creating more responsible consumption and production, climate action, action being the other one, and partnerships for the goals. I'm not going to delve into these, and I'm going to finish off with looking at some of the high level trends that we as an exchange have been looking at for a number of years and we see as sort of dominating. These are not the only ones, of course, but I thought I would just share these with you because these are some of the ones that we think are coming to the fore. So yes, notwithstanding the US president's stance, there's definitely greater focus on sustainability from all quarters. And this thing about the large expectation of the private sector to show leadership, if any of you follow the Edelman Trust Barometer, it measures the level of trust of civil society in the different entities, being the media, governments, NGOs, and business. And over a number of years had a very worrying trend of declining levels of trust. I don't need to tell you, I'm sure you feel that you don't trust many of these entities. However, what was very interesting in the last version was that suddenly this expectation for business leadership to show up and to take leadership was actually quite encouraging. So the opportunity there for private sector to show leadership has suddenly become quite important in this greater element of trust. And the communication around sustainability has a large role to play in engendering this trust. The next one, again, linked to that, the private sector becoming more visible and active. I've mentioned to you, for example, the GIST Alliance. Then you would have noted the CEO Roundtable commitments. The World Economic Forum 2020 focus this year had a lot around sustainability, and there was so much that was said. And one hopes that momentum will carry through post the crisis that we're in. The third one on climate change and associated systemic and financial risks dominating the discourse. This one is clear. I think when you think sustainability, most people see climate change as the poster child for sustainability, and that's completely understandable because it's probably front and center of anything we talk about when it comes to sustainability. But just a caution that sometimes it can crowd out other critical sustainability issues. And so always to have that conversation in a slightly more balanced fashion. Of course, the issues in relation to sustainability have, in relation to climate change, impact on all the other sustainability issues quite substantively, but one should make sure that we keep this on track. The fourth one on shareholders starting to ask more ESG questions of companies, and we're seeing that the world over. Some local examples, Sasol, Standard Bank, all having faced shareholder resolutions in the recent past, and we're starting to see this type of activism growing and showing a more engaged civil society and saying to companies, we want to know what you're doing. We're not happy if you're not doing things that are actually contributing to the greater good. And in fact, if you're doing things that are not there, we are going to start asking questions about those. So we're certainly suddenly starting to see more of that kind of activism in this country. The civil society awareness is growing. The millennial effect, of course, where this is becoming the dominant generational cohort, and what they're seeing and what they're considering, and that they want to work for companies that can do well as do good, but also are investing with the same sort of mindset. So the money is going there, and your employees of the future are saying, we don't want to work for you if you're not really seen to be doing the right thing. We're also seeing then on the next trend, the buy side looking for more investable products which are sustainability focused. The needs are evolving quite substantially, and we're trying to keep up with what that means. Often it is a little bit uncertain, but again, these are changing, and as more conversation happens, as well as the discourse itself evolves around sustainability, and we become more aware of what the critical issues are. This will continue to change. Often they're dictated by the mandates that they get, and the global institutional investors are taking the lead. Many of you would have heard of BlackRock and Larry Fink's annual letter. And if you look at, for example, the employee pension fund in Japan, I mean, taking huge leads, huge strides, and making public statements and public commitments to actually investing in companies where there is some ESG screening done, and ensuring that they act on that. There are varying degrees of maturity amongst investors, of course, but we have seen that globally, the responsible investment asset under management has been growing, which is very encouraging. The next trend is a growing momentum for the alignments of standards, frameworks, and definitions. Why is this important? So up to now, by and large, sustainability frameworks fall in the voluntary space. And so companies or whoever reports according to these or uses these does so on a voluntary basis, which does mean there has been quite a proliferation of a multitude of standards and frameworks. And so the call for the alignment of these has been there, both by investors as well as by issuers, to saying we need to try and understand and streamline so that it makes it easier for the actual use of that information. And so that is happening on a global scale. And there are projects that are underway that are looking at that. And of course, and lastly, of course, in our context specifically, what is very encouraging, and I would say over the last year and a half, suddenly an uptick in company interest in sustainability, in what it means, in why it matters, in how they should start considering it. And I think that that has been very, very encouraging, and hopefully means that suddenly there's a convolution of factors that are coming together to create this set of circumstances that are allowing for better action to happen, because we definitely do not have time to achieve the sustainable development goals. So I'm just going to leave you with the thought that if we don't invest in the future that we want, the one that we get will be worth infinitely less. Thank you.
Thank you very much, Shamila, for a wonderful and comprehensive presentation. It's great to see the continued leadership that the Johannesburg Stock Exchange is demonstrating, both domestically here in South Africa, but also internationally with respect to the various initiatives in which the JSE is participating and leading. I'm sure there'll be a number of questions directed to you in advance of our moderated panel discussion. So Shamila, thanks again from our side. We really do appreciate your participation in today's webinar. For those that have joined this webinar, please do remember to ask your questions using the Q&A tab, which you'll see to the left of your screen, top left. And you're welcome to provide a comment there or to ask questions. And we will be using some of those questions as input into the moderated panel discussion, which will be in the second part of this webinar. We would also like to ask your participation in poll questions. And so I'm going to ask Adolphe to load the first polling question, which will come up as a pop-up on your screen. And we'd like to understand who we have on this webinar as our guests today. So we'd like to know which of the below options best represents you or your organization. And it's also a means to test our polling function. Are you representing an investor or a corporate? Adolphe, if you can, well, okay, you've loaded this one. Let's try this one. This is really around your interest in joining today's webinar. Please, would you advise whether you've joined today's webinar to learn more about ESG, you want to learn from the expert speakers, you want to better understand COVID-19 and its impact on business and society, or you've got extra time in your hands thanks to lockdown. Please, won't you select the most appropriate answer? And after a while, we will then publish the poll results. Right, so we have our poll results. It's also a good way to see how many people we've got on the webinar and engaging with our content. So it looks like we have 41% of our guests wanting to learn more about ESG. Close to that, we have guests wanting to learn from our expert guest speakers or guest presenters today, and 20% wanting to better understand the impact of COVID-19 on business and society. I'm rather pleased to see that we got no votes thanks to people joining just because they've got extra time on their hands. Thank you very much. Adolphe, if we can do the first question, which is understanding our webinar audience better. So who do they represent? Do they represent investors, corporate, government, civil society, NGOs, or academia? If you could choose one of those, please let us know who you represent or which industry or sector you're from. That would be helpful for our speakers to understand our audience today. That should be enough time. Let's have a look at the results, please, Adolphe. So it looks like we have strong representation from business or corporates, followed by investors, civil society NGOs, academia, and lastly, government. Great to have such strong support from these sectors, and we really do appreciate you joining today's webinar. Our third and final polling question before we hand over to a theme from Shamila's presentation, and that is the question: what do you think will happen to the general levels of environmental awareness and action in the post-COVID-19 world? Will they stay the same, improve, or worsen? Adolphe, are you able to load that? Thank you. Just please take a few minutes to answer that. Could we have the poll results, please? So I think we're all optimists on the webinar by the looks of things, with 51 votes saying that things will improve when it comes to the level of environmental awareness and action in a post-COVID-19 world. I think there is certainly general agreement that it's an opportunity to press the reset button and to focus on what's most important when it comes to social and environmental issues. With that, we're going to hand over to Robert Lewinson, Head of ESG Engagement at Old Mutual Investment Group. Rob, we're really looking forward to what you have to say to us, and thanks for joining us today.
From a technical point of view, I think we can just give Rob a second. I have to change on this side from presenter to presenter, and I think it just takes a second or two, and give him a chance to be able to share his screen.
Good morning, everybody. Can you all hear me? So thank you once again to Six Capitals and Alternative Prosperity for this opportunity to present our views on the power of sustainable investing and why it has such an important and continued important investment imperative in terms of how we integrate ESG in our investment decision-making process, number one, and number two, what our stewardship obligations are post-investment decision-making. So the format of my presentation today will follow just a general recap of the context for responsible investment before we delve deeper into our investment practices and evidence some of the results thereof from an ESG integration perspective. So let's get started. There's quite a lot to get through, and I think one of the key factors from my side is to sort of, in the back of your mind, keep in mind how the world that we currently or have been driving towards in the last few decades has resulted in this pandemic being so prevalent and so replicated. So I will try and make a link to COVID in going through the context around where we find ourselves in the world today. So yes, I mean, the bottom line is that we live and breathe in a closed and connected complex system. What happens in one side of the world and in one sort of thematic issue very much impacts and has a direct impact on some of the other factors maybe in a different part of the world, but in another theme. It's complex. It's not easy to sort of unpack in one specific pillar or sort of silo. You have to see things holistically, and you have to see things in terms of their impact from one area to another. one of the key evidences of the interconnectivity is the impact of population growth. Now, we will closely and acutely understand that because of the increase in population, without dealing with the associated issues and context around those connectivity issues that I mentioned earlier, you will start to see the sort of problems developing in the way we see the world unfolding. And what would be interesting to note is this was sort of pinged a bit earlier, and if we had to look at COVID and isolation as disease as being a subset or a sub-result of the population exponential population growth from the mid 1900s to where we were in 2011 to what is projected to into 2050. So this is just one example of where the sort of externality or external costs of exponential population growth and not dealing with the key risks to society as a result. The next slide again just evidences what that acceleration actually looks like. Yes, we've seen exponential population growth, and I use the term exponential because it's used quite radically, but in terms of the current crisis. But if you look at all of these sort of underlying factors, each of which display from one extent to another, from about 1950, which is that thin blue line in each graph, an exponential growth from everything from population to McDonald's restaurants to international tourism to the use and the ozone depletion, etc., etc. We are in a great use and consumption of the world's natural resources and in a scale that's never been seen before in the entire history of the world. So we are focused then on our planetary boundaries, and what really can the Earth sustain without going beyond the sort of the safe zone. And the safe zone is what we look at in the green but highlighted, and we can really see that we are beyond that planetary boundary in terms of climate change, the rate of biodiversity loss, and the nitrogen cycle biochemical flow boundary. These are the idea of what chemical pollution and atmospheric aerosol loading has not quite yet been quantified in terms of where we sit in terms of the boundary, but these are the sort of the current status quo for the remaining factors of the use of our planet's natural resources. We also note that in terms of carbon emissions, we are at the highest point ever in the Earth's history, dating back, from sort of the mid-century. We've got data from a observatory in Hawaii from 1958, but previous to that, we've been able to extract this data from ice core, and it shows that in total, as we stand reading as at August 2018, that we will hit the highest level of concentration of CO2 in the world at 407 parts per million, which is higher than any other time in our history. Apologies for that. Even with normal sort of Earth explanatory volcanoes, whatever else has been ascribed to natural carbon and cycles, this last 50 years or so has been ascribed to the Anthropocene, or the human impact on the environment in terms of carbon CO2 concentration. So we've also seen a proliferation of science being put out into or summarized for policymakers around key issues like climate change and land, but it's not limited just to the overall perspective, but delving into specific areas like the ocean and other ways, what we call the blue or the green economy. real risks of climate change are there. We know for sort of where those risks lie, and starting to see some of them in the recent, like for example, wildfire damages. If we look at on the left of the graph, we can see where we are in terms of rise of temperatures from pre-industrial levels. The sort of the UN or the Paris Agreement are around limiting to it a change in pre-industrial temperature to a 2-degree world. You can see sort of that line over there, and already we're starting to see the effects of a warming climate on things like wildfire damage, permafrost degradation, etc. When we get if we don't reach some of the goals set out in the Paris Agreement, and some even recommended by the IPCC in terms of limiting to a 1.5 degree level warming, we will exponentially again see the effects on some of these key areas for our safe operating environment become extreme as we go up the chain in degrees. So it really highlights the impactful stage, or the impact that the warming of the global of the environment will have on the overall risks and environmental and social instability. To give an idea of what this actually looks like in real terms, I mean, this is a map of the Bering Sea in sort of the sea between what is Alaska and sort of very far eastern Russia. This thin dotted white line represents the sort of the area of permanent sea ice lost in a period of sort of 5 years. That represents an area of about 500,000 kilometers, which is about 20 times the size of Kruger National Park. It's a serious amount of permanent ice damage which has been caused by the warming environment. I think we can just touch on what we need to do in order to bring down that the level of temperature increase over time. And what this is called is the transition. We need to both transition away from a high carbon or fossil fuel world economy with associated physical risks, which we mentioned earlier. And there are various pathways in which we need to get there. And there are now, as you can see, a number of projections in terms of what those pathways look like if you had to tinker with certain ways to transition towards green economic growth, as opposed to business as usual with using high fossil fuels and high carbon intensity. So I think to sum it up, I find this quite a useful graph in terms of where we are currently. And this is, if we look at between what we have already burned between 2000 and 2011, we've already used this part of our carbon budget on the left hand side. We only have this remaining part of the carbon allowable to remain within the sort of the safe zone of the 2-degree budget out to 2050. However, if you look at what are the total reserves of fossil fuel around the world, you can see that it will exceeds what is allowable from our side, what's remaining from our side to remain within a 2-degree world. So the real possibility of some of these reserves being stranded assets is quite significant. We also, if we shift quickly to out of the environment into inequality, we can see that inequality is rising in both English-speaking countries as well as Europe and others. We've seen that in the sort of the continent of Europe and Japan are following a far more a sort of less or more equal approach to their populations in terms of equality than the English-speaking countries, which are actually adding to the inequality standards over time. And it's interesting because as we've seen inequality drop through the 20th century out to 1970 and the 80s, we've seen it pick up radically in the last 30 years or so. So that's evidence of where, and of course, South Africa, as was mentioned by Shamila earlier, is at the top end of the highest Gini coefficient and highest inequality in the world. So there's a lot of real risk out there, and we need to contextualize and understand that we need to look at things in a more contextual and more holistic way, because the context for South Africa is real. We will certainly see the impact, and already see the impact of the COVID pandemic on the persistent social inequality in South Africa, in terms of the response, and we probably have yet to see the real long-term effect of the pandemic exacerbating the existing social inequality in South Africa. However, what we're also seeing is a huge groundswell globally and in South Africa around this is enough is enough. We aren't seeing a sustainable outcome here, and things have to change in order for us to ensure that we have a future sustainable and development in the green economy and a more just and equal society. So the trend towards ESG and capturing this opportunity has been growing fast as well, which is really the sort of the good news. And here we see examples of signatories to the UNPRI in terms of number of signatories growing, and sort of total assets under management. And we have seen a significant increase over time in those signatories, and the ability of the willingness of various asset owners and asset managers to sign up to evidence their commitment to changing and being part of the future of global finance, rather than continuing to have business as usual. So there's a number of different reasons, as we've sort of as Shamila had touched on in her presentation, around why this change is happening, why now, and why there's this groundswell of support for acting and investing responsibly for the future. So we're also privileged in this country to have both the sort of the principles of responsible investment on the one hand, and our local code for responsible investment, but further to that, we have the actual legislated industry response in terms of Regulation 28 to the Pension Funds Act, which says that pension funds and trustees of pension funds must consider environmental, social, and governance issues in the investment decision-making process. This was further given credence to by the guidance notice, which was issued middle of last year, which says that, in a nutshell, that pension funds must publish in their investment position statement their commitment to responsible investment. They have to evidence how they integrate ESG in the investment decision-making process, and finally, they have to evidence how they are an active owner or steward of those investments post the investment decision-making process. So this is quite far advanced. We are starting to see some examples around the world of more legislated and more certainly of stewardship activities and ESG integration, but South Africa was far in advance of that at the outset. So, is it time for a reset? We believe it is indeed. It's overdue, long overdue. We've been sitting kind of with our heads in the sand as allocators of capital, as takers of capital, as investors, as stakeholders, etc., for too long within the current regime of enterprise capitalism. It's this idea of connecting to a shared value or purpose for driving profit will be a key factor in terms of how the world resets post this COVID crisis. And I think that'll be it's quite an inflection point for evidencing that it's time to change. And the changes are happening. I won't spend too much time on this. Sharmila has covered this in her presentation around the Sustainable Stock Exchanges Initiative and integrated reporting and other frameworks which are enabling the disclosure and transparency within the overall system to allow investors and other stakeholders to make decisions and assess companies in terms of their ability to transition to a more sustainable future. The millennial revolution is happening. It has been happening quite for some time, and this is only a start of where the revolution towards sustainable investing trend will go, because as millennials take over wealth from the baby boomer generation, we'll start to see the key questions around where the purpose for which that money has been invested being asked time and time again. And it will be those investment houses that are able to offer a value differentiation with the ESG practices will be the ones to win the new money or millennial money in the future. So I'm going to touch in terms of what the SDGs are applicable to the JSE is what their touch points are. If we're looking at it holistically, the SDGs are basically the best collective plan that we have in terms of the key themes that need to happen for us to transition our world effectively. There's so much within each of those goals, and the key from our perspective is to ensure that, not only that companies say, well, we are in such a sector with this type of business and we can impact these 3 or 4 goals that we actually are most impactful, but we also look for companies' management to own and take ownership of one of those goals in terms of their direct day-to-day operations. So it may be dependent on what that manager or that senior executive works within that type of business will take on a specific one of those SDG goals and be able to account for it in terms of how the company responds to it. We know that ESG is driving value within companies. The traditional financial assessment doesn't account for all the intangible assets which are attributable to value on a company's balance sheet. And these types of things on the right-hand side of my screen, you can see can either add directly to value of a company or can detract from value when one of these factors are lost, for example, poor corporate governance. So we also, in terms of delving in a bit in terms of where the research is guiding us in terms of why this matters, and Sharmila touched on that in terms of why is the interest building in terms of real interest in driving towards more companies' interest in driving towards more sustainable future. It's because the real impacts on the company's cash flow valuation and other types of return are being linked to the ability to manage ESG risk and look for ESG opportunities. So not all companies are necessarily impacted by the same cash flow idiosyncratic or valuation channels, but they do, to some extent, have a touch point with each and every one of those channels. So we are starting to see a real link, in a nutshell, between companies that have lower cost of capital, better performance, and have higher valuations because they are rated better in terms of the ESG management practices versus their peers. And this is what the study actually evidences. We've seen this, other studies support that very much in the same way. And an overwhelming majority of these studies show similar evidence and are quite prestigious in terms of their takeaway points and the level of sources research. Okay, so if we pause here and just get onto our investment responses, we've seen, in a sense now, I've taken you through the context, why, the how, and what the science shows is absolutely necessary in terms of how we transition. Now, how do we actually get this done? And I will go through now what our investment responses to the global context are. So just to break down the pillars, yes, we look at the E, S, and G in various ways, in various themes, and with various key issues. But just to note here that not every company is faced with the same type of issue, same type of ESG issues, or those issues which are material to the way those companies face risk. So we look at companies very much in terms of their unique place in and their operations and their places within specific sectors, and then those issues will come out around those key sectors. There are different approaches as well to sustainability. We can use value-based investing, which we ESG integration, impact investing, or blended approach at Mutual Investment Group. We use an investment approach using many of these different types of approaches to sustainability to create a bespoke portfolio for our clients, and whatever clients' needs or willingness are to or outcomes that they want to achieve from their investments, those are then blended into how we are able to position a portfolio for our clients. So let's take a quick look at getting the ESG insight into a fundamental equity or listed equity process. Quite a lot of information has been plugged into this process, and we'll just evidence quickly how ESG fits into this specific area in our listed equity. So we use, on the if you look at the left-hand side of the screen, we use three types of processes within fundamental equity. We've got a proprietary quant-based ESG screening score. We do bottom-up quality ESG research, and finally integrate our views into the valuation of that particular company in an investment portfolio, as well as the positional size of where that company should be based on the ESG strengths. So you will see this in terms of these bubbles within research, valuation, and ultimately in risk management. So that's where we are currently, and we are also currently building out and developing further, strengthening our our bench for additional ways to evidence ESG within the investment portfolio. To sum it up, we start with our ESG proprietary scoring. We break these up into various scores into quintiles, and what's interesting to see is those in the top quintile tend to outperform those in the bottom quintile or the lowest ESG scores. We then conduct fundamental research, dimensioning the ESG risk between short to long term, and the materiality and the scale of impact of that particular risk. We then overlay those holdings on a monthly review and integrate the thinking and thoughts that come through, or that from those that overlay into our valuation portfolio construction process. That process is owned by investment teams, and ESG is really a plug point into that process rather than sitting outside or alongside that process. And we sit with teams through their investment views and investment decision-making process, and incorporate ESG as a key view within that. Post-investment decision, here on this purple block on the right, on the top here, is our stewardship commitment to post-investment decision-making, to engage in proxy voting and company and market engagement, and that's driven primarily by our RI team. If we look at a specific example of how this works, we noted a company, Glencore. It shows up in our ESG score in the sort of the bottom quartile with a negative momentum. We've assessed the fundamental risks around Glencore, what their key sort of ESG issues are and the scale of impact that they will have. And then we build out the thematic and research view around each of these key risks in terms of the investment decision and how that and integrating that into the investment decision. And as a result, there was a decision made to divest or to reduce our exposure to Glencore in our portfolios as a result. We talk to stewardship. There are three ways we see there's a number of value add propositions within the stewardship. What we ultimately want to do is to get companies to improve on their ESG risk management practices and look for ESG opportunities, given that the evidence is showing us that those companies will outperform in the long term. We see our stewardship proposition as lowering risk, driving positive change, supporting long-term market resilience, having no real impact on the underlying portfolio management practices, and simple implementation. And to all of that, the client gets a whole lot of benefits which a non-stewarded portfolio would not necessarily have. If we look at a sector view from we took and some of the need which is quite quite relevant to the alternative prosperity and Six Capital's viewpoint of the world. We did a sector analysis of companies and their BE scores, and we looked to those companies. Firstly, we dimensioned those scores between sector and where they were in terms of contribution. And we found that in the retail sector there were a number of laggards from a transformation perspective, mainly because it wasn't seen that there would be a social license to operate within the sector as a whole. But as much as we saw laggards, we also saw that some companies would take it upon themselves to transform because they saw transformation as part of their shared values that create business opportunities, fulfill societal need, and increase company assets and expertise. And one of these companies, just an example, is the TFG, where we started with an engagement with them around their transformation practices. A few years ago, they were level 7, and last year, I think they achieved, just to the end of last year, they went up to a level 6 and have improved. Importantly, not necessarily the equity ownership aspects of the BE score, but all the other key factors with that make up the BE scorecard. So quite a good result as a result of from our engagement or stewardship with TFG around their transformation practices. Another case study, and we go to the other side on climate risk. Again, we've assessed Sasol in terms of where they are. So we see both that they're coming up on their proprietary score and the lowest quintile with a decline momentum. We also see that their commitments to reductions in their carbons and carbon intensity, as well as their exposure to carbon gas emissions. I mean, they're the highest greenhouse gas emitter certainly on the JSE, and well in many respects among many global peers. They also have very modest ambition to bring their emissions down, and we have had a number of. On the other hand, we've had a number of important and significant engagements with them around the exposure to climate risk, and will continue to shift their dial in terms of mitigating that risk effectively. We ended up to a point where we were prepared to file a shareholder resolution with other institutional investors, calling for them to publish more transparency around their greenhouse gas emission targets and what they and the key, and importantly, to link those targets to long-term, both short-term and long-term executive remuneration, to incentivize the company to transition their portfolio, their operations accordingly. So quite a key sense and a keen interest from a number of South African institutional investors to really shift the dial and change the way that the company has been run currently. We've had other recent engagements, and really just in terms of our commitment to stewardship, both at a company and on a market level. So just some of those are listed here, and I'm happy to answer any questions around those. Summary of engagements with 2018 is a little outdated. We are in the process of publishing our latest 2019 company engagement output, and what we will see here is that it's where in the past might have been linked, a lot of the engagements linked to governance. What we're seeing is many more engagements linked to issues of environmental and social, social nature. And we'll be pleased to note that in the 2019, I'm more than happy to share that annual report when it comes out, that the spread between environmental, social, and governance issues becomes even more even. So we just talked to product performance quickly and why we believe, that companies that manage the ESG practices will perform better over the long term. We've got two indexation products on the market at the moment. We are launching a third one soon, a world ESG, a emerging markets ESG, and a South African ESG best-in-class index. And what we basically do with each of those, we start with the market cap index and apply certain methodology which has been published by MSCI to create a best-in-class index. We screen companies for business involvement and controversies, their ESG score, to ultimately create an index which is very similar to the market cap index, but has applied ESG overlay in that indexation product. And we see the results also slightly out of date, these results. However, what is also pleasing to see is that even through the COVID crisis, that the ESG funds perform admirably through the crisis, and actually have in many respects outperformed their parent benchmarks. So for those, to answer the question, for those who don't, you have to suffer financial a haircut on financial performance as a result of investing in ESG? The answer is no. In fact, the opposite seems to be true. If we look at the emerging markets, for example, that is even more apparent. So the other aspect is what we talk about in terms of investing in the green economy, and that's something that that's investing for the future, investing for the fixing rather than continuing the current status quo. So we have opportunities in our alternative listed assets and our unlisted assets to really shift the dial around firstly being exposed to green themes, and secondly to the ability to influence how those investments happen. Now, we talked about, or Shamila talked about, green bonds on the JSE, and we see that in fixed income, that the exposure to green themes and social bonds and green bonds are only going to increase over time. On the right-hand side of the screen, though, we have actually direct impact investments in these different themes, green growth themes: education, healthcare, agriculture, public transport, infrastructure, and the like, and low carbon energy. So all of our impact funds, our infrastructure funds, and private equity, and many of our private equity funds are linked to these green growth themes in a number of ways. And the bottom left of the sort of the quadrant, we've already talked to listed equity, which has a very lower indirect level of influence, which is covered by enhanced engagement, and the exposure to themes is enhanced by ESG products. Our impact to date, there's there's some very nice information on the slide, But in total, if you look at what our total AUM is in terms of assets under management from the investment group, which is sort of around about 700 billion rand, we've invested approximately 150 billion of that rand in the direct green economy impact. And how we know that is we've adopted a taxonomy which is very similar to the EU green taxonomy, but with our own overlay in terms of how we impact or how we invest and tag those assets appropriately to be counted into the green economy. And the main thing is that the impact is felt directly within the economy. So in conclusion, the key takeouts, if we're going to leave you today, ESG issues are material and playing out in real time. We see this amplified by the COVID crisis. We believe that ESG themes will emerge from this crisis in a far stronger position and far more urgent position to deal with investing in the green economy, to be part of the fix in a post-COVID world, because we can see the real impact of a pandemic as a result of externalities that are played out by an ever-growing world. Regulation best practice require action. We're starting to see those coming through quite significantly. We'll see more of that, I believe, as a theme. ESG integration is a new best practice standard. I think we come to a point where it would be unthinkable not to look at ESG in terms of your investment decision-making process in the current environment. And we have evidence that we can do well by doing good and investing in a green economy outcome that matters. So thank you very much for your time today, and I look forward to answering any questions that you may have going forward. Thanks very much.
Thank you very much, Robert Lewinson, Head of ESG Engagement at Old Mutual Investment Group. We really do appreciate the comprehensive presentation, helping us understand the context for the growing increase in environmental, social governance and stewardship activities on behalf of companies and investors. But what was also good to see was the approach adopted by Old Mutual in terms of your stewardship activities, as well as the impacts of your investments. So thank you very much, Rob Lewinson. Colleagues, mindful of time, we're going to unfortunately have to abandon the proposed 10-minute comfort break. But as this is a webinar, you're obviously welcome to grab a coffee, take a comfort break, and join us when you can. What I'd therefore like to do before we hand over to Graham Maguire from the Western Cape Provincial Government, from their Green Economy Unit, is just to bring up two further polling questions. So Adolphe, if you could assist me, I'd like to bring up question number 3, which is a rating of the following statement. ESG has been placed front and center on the agenda for business, government, and society in addressing COVID-19 and in preparing for a post-COVID-19 world. We'd like you to rate that in terms of whether you agree or disagree. If you could just give it, let's say 5 would be 100% in agreement, and 1 star would be not in agreement. So the rating would be 5, fully agree, 1 star would be less agreement. So it looks like we are more than halfway. Good to see that we still have strong participation and attendance on the webinar, with general agreement that ESG is certainly going to be front and center on everyone's agenda in addressing COVID-19. The task force on climate-related financial disclosures, please. The question is, are you or your organization familiar with the task force on climate-related financial disclosures? Yes, no, or not sure? So it's good to see that most people are familiar with the Task Force on Climate-Related Financial Disclosures. There obviously is still a lot of work to be done in terms of raising further awareness. And I'm pleased to let you know that Gray will be speaking very briefly and at a high level to TCFD in terms of his presentation. Adolphe, if we could have one final polling question, and that is around the UN Sustainable Development Goals. The question is, are these UN SDGs our best plan for global collective action? Do you disagree or agree? So it seems that we've got very strong agreement, 4 out of 5, with webinar participants agreeing that the UN Sustainable Development Goals are indeed our best plan for global collective action. Thank you for your assistance there, Adolphe. We can start loading Gray's presentation, please. Also, just a reminder that we will not be having the 10-minute comfort break as planned. Please do feel free to step aside if you need to and join us when you can. Looking at the time, we don't want to rush Gray and his presentation, so do prepare yourselves for a somewhat shortened, moderated panel discussion. Please do join us for as long as you are able to this morning. Looking forward to your presentation, Gray.
Just a second. Good morning, colleagues. Can you hear me? Good morning, colleagues.
We can hear you. Thanks, Gray.
Great. Okay. Thank you, everybody, and thank you to our previous presenters for giving me an excellent platform to start my presentation from. I'm going to be trying to slay a few birds with one stone here. On the one hand, obviously, I'm trying to very much present to the government perspective in terms of how it is that we're looking at ESG integration in the financial system and how it is that that relates to the government perspective. But I'm also going to try and provide some context from our side of things as to how it is that investors can start to anticipate that government is going to be responding both in terms of the environmental crisis, but also in terms of the COVID-19 crisis and how we need to respond. So I think it's going to require a little bit of lateral connection in order to be able to connect all of the various dots here, but I'm going to give it my best shot. I'm hoping that most people would have seen this slide at the start of the year. I realize that January probably feels about 5 years ago by this stage now. But in January, just ahead of the Davos conference, the World Economic Forum released their global risk report. And as you can see here in this slide, the most pressing issues in terms of likelihood and severity of impact, all top 5 of them are all environmental impacts this year. And there are some very interesting implications in terms of how it is that we've been able to get into the situation that we are in now, which I'm going to go into in just a second. But one of the key things that came through from that biodiversity, well, from that risk report, was this top quote here from that report. And it was really as though the drafters of that report had a crystal ball at the time when they were busy writing their report, where they said that biodiversity loss has critical implications for humanity, from the collapse of food and health systems to the disruption of entire supply chains. And I think, especially if you look at the second quote, you can really see how absolutely prescient that is in terms of the fact that the United Nations International Resource Panel have calculated that 90% of biodiversity loss and water stress are caused by resource extraction and processing, 2/3 of which is done by private business. And I think you'd really have to be blind not to see the stress that is being placed on our food system in the country at the moment, as well as obviously our health system, and how that's also having impacts on the delivery of business supply chains, which is something that I think that we really need to be cognizant of as we go into the post-COVID recovery environment. We've already seen companies like Tiger Brands, for example, a year ago, lost enormous amounts of their share value as a result of the listeriosis crisis. And one of their responses has been in order to be able to take a much heightened degree of vertical control over their supply chains. And I think that that's going to be a trend that we see going forward, coming out of this crisis in particular. And I'll mention later on in my presentation some of the concerns around the biodiversity loss angle, particularly within the South African context. But I just think that it's really important to be able to emphasize to the listeners here today the fact that essentially, I wrote an article about this in Business Day last week about the fact that, for many South African businesses, they feel like they're being punished because of the fact that, first we have to go through the drought, then we have to go through the COVID-19 crisis. And it's important to recognize that neither of these two things is unrelated. They both stem from our ineffective ability to be able to engage with the natural world. It's very much the case. I mean, nowadays, 75% of new diseases that are coming into the human realm are zoonotic diseases. This is according to the Center for Disease Control. So it means that they're jumping directly across from the animal kingdom, and a large part of that is due to biodiversity loss. And obviously, on a similar level, that's also the case when it comes to climate change impacts, which we can only anticipate getting worse. So really, in terms of genuinely seeing the implications of this slide here, where it is that these big risks are starting to really play out in the real world financial sense, we are seeing that. It was interesting as well. I really enjoyed listening to Rob's presentation. It's obviously a very comprehensive perspective, and you might recognize in this slide over here, very similar to one of the slides that Rob had presented on as well, except with a slight difference. One of the key things that we in government are starting to try and push much harder for is for planning that looks within the donut. So what Robert presented on was the ecological ceiling, which is that outside ring that you see there, where it looks at a range of 9 different environmental impacts that all have got ceilings beyond which you cannot go, because then you get into the range of environmental collapse. But what was missing from that particular slide was the social foundation, because the unfortunate reality is that there are many countries in the world that exist well below the ecological ceiling in terms of the fact that their resource consumption and pollution levels are much, much lower than their ecological ceiling. But not many people want to live in Mogadishu or in southern Sudan or in Sierra Leone. Those are not really, that's not the kind of lifestyle that we want. So what we need to do is we need to ensure that our level of human development is above a certain level, and that will be the social foundation. And really, there's actually 3 different metrics for measuring this, which I'm not going to get into today. But yeah, this is definitely, I think this combined perspective is really critical from the government planning perspective around how it is that we intend to deliver on services. And I'm going to speak to 4 different approaches that we've got within the Western Cape government that we are busy addressing at this moment in time. And I'm hoping that this provides some insight into private sector planning as well. So in terms of private sector planning, what we're seeing is that this broader sustainability crisis is driving this set of 8 different inevitable policy responses, which I'm not going to get into here, but basically this is setting the trend in terms of what it is that the ESG performance areas are going to be from a private sector business perspective, and particularly as this crisis starts to loom. But in the case of Western Cape government, what we're looking at the moment, and where it is that I'd like to start off on, is the ecological infrastructure investment framework, which draws a line between the biodiversity loss issue and how it is that we intend to be able to deal with that through a sustainable financial model. Similarly speaking, the Sustainable Infrastructure and Finance Facility looks at how it is that we integrate planning for infrastructure and for social delivery into the Western Cape systems into the near future. Our cash management and investment policies, and then lastly, the Green Outcomes Fund, which is an aligned fund that's been developed in partnership with the World Bank, the Birthday Center, and the Jobs Fund. So I'm going to try and cover those 4 themes in as brief a setting as possible. I'm sure that everybody who is on this webinar is aware of the fact that last year, the Western Cape, yes, it was just last year, was facing the day zero crisis. And this is a photograph here of the Theewaterskloof Dam, which was down to its last 10% of water. It's obviously an enormous crisis. And we needed to be able to investigate how best to be able to resolve this crisis. What we did was we did a financial evaluation of the best ways in terms of a rand use value to be able to effectively free up more water into the greater Western Cape system, but particularly into the City of Cape Town system. And what we discovered is that the removal of alien invasive species, that's the top line over there, represented the least cost with the highest amount of return from a water perspective. Not desalination, not groundwater exploration, not water reuse, not additional storage, but in fact, clearing alien invasive species out of our catchment management areas, which is a direct biodiversity investment application. So we needed to be able to find a way in order to be able to drive that. Because on the one hand, we have very limited finances in order to be able to do that. But secondly, we also need to ensure that we're injecting as much opportunity into it from both a jobs creation perspective as well as delivering on as many different environmental outcomes as we can. So what we started to do was we started to work with a partnership, which I'll go into at the end of this particular section of the presentation, in order to be able to deliver on a biojet fuel application that will work in partnership with Petro SA in order to be able to deliver biojet fuel into the European market. Now, ordinarily, biojet fuel trades at about €500 per ton. And as a result of the demand for biojet fuel within the European context, we, under the ideal circumstances, should be able to actually get about 3 times that price, which is a considerable cash injection into our overall clearing initiatives, and something that requires large-scale production, and also obviously at the same time means that there's a large potential for job creation across the Western Cape in this respect, which is highly necessary given the growth in unemployment that we've seen as a result of the drought, which lost us about 70,000 jobs across the province, and now obviously with the COVID-19 outbreak. So basically this partnership is in partnership with the EU, Petro SA, the Roundtable on Sustainable Biomaterials, UNIDO, the Western Cape Government, and WWF. So we're busy going through the pre-feasibility stage of that now, and then hopefully going to be running trials towards the third quarter of the year. The next thing that I wanted to be able to refer to was, this goes back to that initial slide that I had mentioned about taking a donut level approach in terms of how it is that government is looking at being able to address both the sociological developmental needs as well as the ecological limits within which we need to live. This slide here was actually drawn from the Amsterdam donut model, which got launched earlier this month as well. And essentially what has happened in the case of Amsterdam is that they've recognized that they do, in fact, need to start incorporating this kind of planning specifically into both their national level planning, but also even at a city level as well. And similarly speaking, within the Western Cape, we're trying to follow a similar kind of process, except that we do have one major difference, and that is the fact that we have massive limitations on our available finance. I'm sure everybody on the call is aware the fiscus is rather constrained at the moment, and in order for us to be able to deliver on this donut level of ideal, sustainable, just living space, we need to be able to develop innovative blended finance planning approaches that are able to recognize the environmental costs involved with non-compliance to best practice, as well as the social demands being placed on that. In order to be able to facilitate that, myself and various others within our development planning and local government department have been working for about 2 years now on the development of a program called SIDAF, the Sustainable Infrastructure Development Finance Facility, which is a blended finance approach towards the promotion of spatial development planning that is able to analyze both the environmental costs as well as maximize investment returns on different forms of infrastructure planning. In the initial case, what had happened was that we engaged a research report back in 2016 that did an analysis of different types of infrastructure responses from a local government service delivery perspective, which you can see on the left-hand side of this slide, business as usual, versus the column on the right-hand side, which looked at having a sustainability mechanism for service delivery that looked, in this case, this is just looking at water and electricity, but we actually looked at this across a range of different services, including roads, stormwater runoff, waste, and quite a few others as well. And then what we were able to do was that we calculated what the business as usual cost was, including operating costs, maintenance costs, and total refurbishments, along with total construction costs, in order to be able to have a comparative analysis between that situation under the business as usual environment relative to the sustainable service delivery environment. And here you can see the difference between the two is that the upfront costs on the sustainable service delivery environment were considerably higher than the prior business as usual costs, but the long-term analysis resulted in this reflection of total cost, where you can see the orange columns are the business as usual cost, whereas the sustainable calculation is the red ones. Now, given that we had started to show that this was the kind of benefit that municipalities could anticipate back in 2016, and we didn't really see much uptake in the actual implementation of these kinds of sustainable innovations within the infrastructure delivery sector, we wanted to find out why. And a big part of the reason why that is the case comes down to the debt structure of municipalities. And essentially what is happening is that municipalities are presently not incentivized and in a lot of cases, incapable of being able to take advantage of longer term debt, very often because they lack the scale in terms of being able to engage in bond arrangements, which resulted in us developing SIDAF. And this is this very complicated slide over here is the broader model for SIDAF in itself, which is basically comprised of two different key components. On the left-hand side, the project pipeline component, which is the bit where we help municipalities in order to be able to develop different projects that speak towards their long-term infrastructure needs. And then what we then do is we then do a financial analysis of those projects in order to be able to gain clarification around what the net balance sheet implications of the implementation of those projects will be. And then we've developed a pooling facility and bond issuance facility, the securitization platform, in order to be able to lump those infrastructure costs together and issue bonds against that total sum, meaning that for our non-metro municipalities, and we have about 8 municipalities that are eligible from a creditworthy perspective in the Western Cape, it means that once we get to about 750 million rands worth of debt, we'll be able to afford to do a bond issuance and then finance the development of those projects. And there's a lot of work that's gone into the overall background for this project, but it got signed into effect on the 26th of March. So we are in the process of developing our first initial tranche of projects to go into the project pipeline. The next component that I wanted to speak to was our engagements around cash management and investment policies in between Western Cape government and also then the municipalities that we have within the Western Cape government. there is about, at any given moment in time, about 20 billion rands worth of assets, of financial assets that have been dispersed to both the province and to municipalities that we have invested primarily with the major banking institutions in South Africa. About 85% of that is with the big banks. And what it is that we're starting to look at the moment, unfortunately, the investment policies that are required of municipalities and of the province are only really looking at liquidity, security, and the rates of return of the actual investments that we make. The one thing that we are not really looking into at the moment is what the composition is of the underlying assets in which we're investing. So we're investing through a particular vehicle that's held at Standard Bank or Nedbank or whoever it is, but we don't actually know where that money is being invested in and of itself. And what we are wanting to start to do during the course of this year, I was actually supposed to have started doing it about a month ago, but unfortunately I've been seconded onto the Provincial Disaster Management Response, so I've had my hands a bit busy over the last little while, is starting to look into the ESG performance of the underlying assets in which we're investing. And we realize, obviously, that this 20 billion rand that we're investing isn't massive sums of money, but we're wanting to get particularly an idea of how it is that the security of our investments is being impacted on as a result of ESG performance from the underlying investments. And as you can see here, Rob had also presented on this within the emerging market context. This is what the MSCI ESG leaderboard index looks like specifically for South Africa. And you can clearly see that over the last 10 years, ESG leaders have absolutely been able to differentiate themselves in terms of value. And from that perspective, we genuinely feel that we can build a strong argument for why it is that the security of our investments could be being undermined as a result of lack of ESG performance from the underlying assets that we're investing. I just wanted to also follow on from that one of the things that Camila mentioned had been with regards to the sudden interest in growth in the level of sustainable debt, and particularly in terms of ESG performance that had taken place both in the South African context, but also globally. One of the big reasons behind that, and one of the reasons why we anticipate the differentiation of both ESG leaders from laggards in that regard, has been the massive and recent uptake in sustainable debt over the last financial year. In fact, there was about a 78% increase globally in the issuance of sustainable debt last year, according to Bloomberg. So we think that there is tremendous potential for this overall sector going into the future. And one of the big reasons that we think that that's going to happen within the South African context is not only because of the fact that we've started to see that there's been the shareholder resolutions, such as that Rob mentioned with regards to engagement with Sasol, which we're obviously quite concerned about, as Sasol's Secunda facility is the highest single point emitter of carbon emissions in the world. But we're also starting to see that happening more and more with these kinds of climate resolutions being tabled at Standard Bank, and then Rand Merchant Bank later last year as well. So we're really starting to see that there's been quite a big uptake in that. And we're also obviously very interested to see what is going to happen now that the TCFD is requiring, well, the UN PRI is requiring all of its registered signatories in order to be able to report on both the governance and strategy components of the TCFD this year. So there's definitely going to be quite a big uptake in the level of reporting that's going to be going on with our major financial investment houses in the country. And we're very keen to be able to track how that starts to impact on market performance. One of the additional areas that we're quite concerned about from a Western Cape government perspective is also the growth in carbon barriers and what that means for our export competitiveness. What's happening at the moment is that we're starting to see that there's a massive uptake in internal carbon pricing. It's interesting to see that on the one hand, the President of the United States is removing himself from agreements such as the Paris Agreement. But on the other hand, within the last 2 years, there's been a massive growth in internal carbon pricing within the US and particularly large US corporates as well. And interestingly, that graph that I showed about the growth of sustainable debt, a massive chunk in that growth in sustainable debt has been in the US in particular. So what we're starting to see is that even where it is the case that national carbon barriers are not being specifically raised, at a company level, we're starting to see the integration of internal carbon pricing, which is very worrying for us as the Western Cape government, because South Africa, in terms of per unit of GDP, has the 5th highest level of carbon emissions in the world. And I mean, where we're performing is really quite terrible. I mean, it's behind Antigua and Uzbekistan and in some other tiny little countries. So yeah, it's very much a concern, the fact that we are continuing to have such massive levels of carbon emissions per unit of GDP, and really we're very much hoping that we're going to start to see that there's a big uptake in the level of cogeneration and integration of renewable energy products into corporate, industrial, and manufacturing level energy security solutions in response to the energy crisis across the country. The last thing I wanted to mention, particularly when it comes to the rating tool side of things, is how it is that we're doing in terms of the biodiversity performance rating side of things. This is another report that actually came out last month, and this is the biodiversity performance rating of South African companies. This is the second year that it's being done. It's been conducted by the Endangered Wildlife Trust, and it rated 320 private sector listed JSE companies and an additional 28 state-owned enterprises. And what it did was it reviewed their performance relative to 8 different questions about their biodiversity policies across the company, with a maximum score of 4 and a minimum score of 0. And you can see what it is. The questions are there. But I think the thing that is particularly concerning here is the fact that if you look at the bottom, the overall average score on every single one of the questions was under 1, with the highest score being less than half a point. And that's the first one on 0.4. So overall, biodiversity performance within company level performance in South Africa is pretty much not on the radar of any of our major listed companies. And that is very much going to be of concern, I think, from a global perspective coming out of the COVID-19 response, because it is becoming more and more apparent, both at, from a government perspective, but I think within an international context, that a big part of how it is that we need to respond and limit the long-term impacts of events such as the COVID-19 outbreak and droughts and various other natural catastrophes is to be able to beef up not just our climate change reporting side of things, but also particularly around biodiversity as well. And at the moment now, a group including AXA and BNP Paribas and various others are in the process of developing what is intended to be a global biodiversity performance rating that is meant to be able to help investors at a global level be able to analyze biodiversity performance ratings better. And I'm really hoping we can start to encourage the JSE in particular to be able to put pressure on our South African companies to improve their responsiveness in this regard. The last thing that I wanted to be able to cover is the Green Outcomes Fund, and this is one of these situations where I think that there's been a fantastic level of support from the national level, particularly the Jobs Fund, in order to be able to create, unfortunately, it's not in fact a 542 million rand fund anymore, it's now a 490 million rand fund, so this is a little dated slide from the last year, but still, the concept there, it's a blended finance instrument in order to be able to increase the level of financial flows towards businesses and small businesses in particular, that are yielding not only financial returns, but are also being able to deliver on these 14 different metrics. Say 14, if you look in the right-hand column, you'll note that there are 14 different metrics there. And we're really keen in order to be able to see that, how that plays out in the Western Cape. And in fact, for those of us who are involved in the financial services sector at the moment, there is the call for applications for companies that could potentially be evaluated under the initial tranche of funding will be closing, I think, on the 15th of May. So there still is some time in order to be able to engage in the Green Outcomes Fund. I'd very much like to encourage you all to do that. This is the management structure of the fund. All of the different partners here having been selected for their areas of expertise and the levels of support that they provide within specific different layers of investment finance support to smaller and medium enterprises. And this is basically what it is that the general structure of the funding will be. So yeah, I would very much encourage people to be able to investigate that. But should you find that the kinds of investments that you're looking for don't fall inside of the Green Outcomes Fund, I would also encourage you to go onto the Green Cape website, where there is a database of green finance institutions which are active within South Africa, and there's a large amount of them. There's about 140 different financial institutions on there, and it will give you some guidance in terms of what it is that they are in fact financing. So yeah, those are the key points that I wanted to raise. So thank you very much for your time.
Gray Maguire of the Western Cape Provincial Government's Green Economy Unit. Gray, thank you very much for your presentation and helping us understand what the Western Cape government is busy with in terms of the green economy. The Green Outcomes Fund is certainly a very exciting development and one that we're watching earnestly. So it's been great to hear from the Johannesburg Stock Exchange, as well as Old Mutual Investment Group and the Western Cape government. Great to have the exchange as a regulator, an investor, as well as local government on this webinar. Colleagues, we're mindful of time, and we know that we have gone over our estimated 2 hours. What we would like to still do, though, if you'll indulge us, is I'd like to just ask one polling question before we go into answering a few questions that have been raised by attendees on the webinar. And so let's bring up the polling question, Adolphe. The polling question around future webinars that we host. We'd like some guidance in terms of what webinar topics you'd like us to engage with. And so there's a number of topics that you can select. And if at all possible, we'd like you to just give us guidance as to which webinars topics would be of most interest. So it asks you to please choose the topic of most interest to you for future webinars: climate change, impact investing, fiduciary duty, active ownership, or financial inclusion. Hopefully that polling question will come up shortly, and it would be great if you could give us some guidance as to which of those themes are of most interest to you.
Adrian, I must apologize. That polling question was not loaded. It'll take me 2 minutes to load it. If you don't mind.
Not a problem. Then let's move on to asking some of the questions that have been raised during the webinar. We've got 2 questions posed to Shamila from the JSE. So we have a question from Ahmed. Shamila, if you could tell us how many companies actually make it into the FTSE JSE Responsible Investment Index benchmark. I think that would be of interest to Ahmed and our other participants. And then the second question for you, Shamila, from Luyanda, is around the hybrid approach that the JSE takes, specifically around surveillance and enforcement of listed companies. If you could perhaps give some color and explanation to the approach that the JSE takes with regards to surveillance and enforcement on listed companies.
Sure. Thank you very much to Amit and Luyanda for the questions. On the first one, Amit, at the current point, we have 67 companies that are in the benchmark index. That would have been as at the December 2019 review. The index is looked at twice a year in relation to ESG scores, and then there's a rebalance, relooked at it in interim March and September, not on ESG, but on the other criteria, which is the base criteria. I didn't go into detail on that, but you need to be a constituent of the SWIX All Share Index as well as qualify for the FTSE All World Index in order to be assessed for ESG. So it's on those criteria for the All World and the All Share that the March and September review happened, and on ESG in December and June. So I'm using the December number of December 2019, and that's 67 constituents. We tend to go anywhere between 67 and sometimes 80, but we're sort of hovering around the 60 to 70 mark the last few pre-balances. On the second question from Leander, thank you. So Leander, the different sanctions that exist for the JSE as a regulator are varied. They would usually try to first engage with companies to correct behavior and give a period in which companies can remedy any potential breach or potential questionable activity and engage with the regulator on that. There are quite strict Chinese walls between the commercial part of the business, which is where I generally sit on, and then the regulator side of the business. So I would proceed with caution on my side to respond on behalf of the regulator, because I'm not representing the regulator, and I'm sure you would appreciate that it's not really in my purview to talk about exactly what they do. I can talk about the overall approach, but yes, there are sanctions that would generally start with trying to be remedial in nature first, before going to potentially either fines or even delistings and the like, or suspensions, depending on the severity of the issue at hand. And so the JSE would work with the Financial Sector Conduct Authority in looking at that and taking forward whatever might need to be done, including criminal charges and the like. So that just gives you the spectrum of what can be done, and that is really how the regulator looks at it. Thank you.
Thank you, Shamila, for answering Ahmed and Leander's questions. Two questions for Robert from Old Mutual. Robert, Rudolph would like to know, how does Old Mutual define an engagement? And Deline would like to know, Robert, in your opinion, is ESG or sustainability reporting relevant, targeted, and transparent enough for investors to be able to make investment decisions? Rudolph and Deline would appreciate your response to that, please, Rob.
Thank you, Adrian, and thank you, Rudolph and Deline, for those good questions. Yes, so Rudolph first, defining an engagement can be any number of ways that we interact with the company's management or board. That's on the one level, and a market engagement would be that which mentioned, which would be an engagement with specific regulators or industry players or committees which have a direct impact on responsible investment in South Africa and globally. So the engagement, as we look at it, could look at it in a number of ways. It could be an email, a letter to the board, a telecon, a meeting with the relevant the counterparties, and sort of escalates as it goes up to a point where it may result even in a public shareholder resolution or a position statement in the media. So it goes the full sort of gamut of interactions around key ESG issues. We're talking about those that are related specifically to ESG rather than every engagement or discussion or touch point with the company or market. Secondly, Deline, yes, the answer is I don't think it's entirely. We're not there yet in terms of transparency yet, in terms of being fully appraised or being able to act exactly off the publicly available information. Often what we do in our own internal quant screening process, as well as our fundamental research on our listed equity, that we retest the company's own reported data against what we are seeing, and often have variations from what is reported in terms and publicly versus what we've been able to distill ourselves in our proprietary models. So yes, it does. I think it definitely there is a room to improve a company's reporting practices to focus on transparency and relevance. So thanks very much for your question.
Thank you, Rob, for answering those two questions. We've also received two questions for Gray. Mark asks around the fact, does Gray have any other colleagues in other green economy units in other provincial governments? So, for example, Gauteng has got the highest population and is, the economic hub of South Africa. Does Gauteng specifically have a green economy unit as for the Western Cape provincial government? That's the first question. And then a question from Chris around, in light of COVID-19 and the recession and related near-term cash flow constraints on the part of companies and government, how will the investment community look to encourage sustainable project investments? And that's often because of the substantial upfront investment that's required, with savings only realized in later years. Gray, we'd love to hear your response to Mark and Chris's questions, please.
Yeah, thank you, Adrian. Just on the first question, yes, I do know that there are other green economy units outside of the Western Cape. I don't know how many there are. I've had engagements quite a lot at a national level. There's a lady called Mapula Shangela, who is the national coordinator for green economy. And she would be the best person to ask in terms of a other provincial, regional perspective. But there is no particular mandate from national that stipulates that any individual province must have a green economy unit. It is an elective thing to have. In terms of the second question with respect to how it is that companies should be looking at the fact that there's potential for higher upfront costs and there is a lack of liquidity at the moment. I think that this is one of the spaces where the finance sector really needs to start to get engaged. At the end of the day, this is how it is that future contracts are created. You are aware of a particular value at a point in time, and you are essentially taking a bet that the future value at a point in time is going to work out better for you than what it is that you presently have. So in a similar vein here, I think that this is really where financial institutions need to start looking at how they could potentially collaborate or create their own investment mechanisms that could provide upfront capital to businesses that are wanting to engage in sustainability activities. And certainly I would hope that some of our business partners have been doing that. I know that, for example, the Standard Bank, you can get upfront finance of 10 million rand in order to be able to engage in investments around renewable energy projects at a commercial and industrial level. And that is precisely what it is that I'm referring to when it comes to making a financial vehicle available in order to be able to facilitate environmental outcomes. And I'd love to see more of that kind of thing happening.
Thank you, Gray. And colleagues, I know that we have run over time, so we're going to wrap up the webinar now. What I would like to ask is if Adolf can just bring up the final poll for the day for this webinar. And it's really just a request from our side as hosts, Alternative Prosperity and Six Capitals. Just if you could give us an indication of themes or topics for future webinars that are of most interest to you. Please would you select from either climate change, impact investing, fiduciary duty, active ownership, or financial inclusion. Please would you let us know if any of those topics are of interest to you. On behalf of Alternative Prosperity and Six Capitals, while you do so, we'd just like to express our thanks and gratitude to our guest expert speakers or presenters, Shamila Subramani from the Johannesburg Stock Exchange, Robert Lewinson from Old Mutual, and Graham Maguire from the Western Cape Provincial Government. Thank you very much for your time and willingness to participate in today's webinar. Thank you to everybody who joined our webinar. We really do appreciate you joining us today. We will be making the slides available, and we'll send those via email, as well as a recording of the webinar, which may take a little longer than the presentation slide sharing. Interesting to see, just in terms of the poll results for future webinar themes: impact investing, active ownership, financial inclusion, and climate change, seeing the most support. Please do keep in touch, do stay safe, and keep to social distancing protocols. We very much look forward to staying in touch. Thank you for your time and your participation, and enjoy the day further. All the best. Go well. Bye-bye.